The salesman was nice to you because he just made more money off your loan than off the car. Go ahead, sit with that. You spent 2 hours in that showroom. You did your research. You compared trim levels. You watched YouTube reviews. You negotiated. You got $300 off the sticker price and felt like you'd won something. The salesman shook your hand, smiled, walked you to the door.
And the whole time, there was a second deal happening, one you didn't know about, one you weren't invited to negotiate, that cost you anywhere from $1,000 to $4,000. And you signed it, happily, because you didn't know the game has a back room. Let me show you the back room. There's a department in every dealership that most buyers never think about. Not the showroom floor, not the service center, the F&I office, finance and insurance. It sits at the back of the building, past the sales floor, past the handshake moment. You get walked there after you've already committed to the car. You're excited. You're tired. You've been there for 2 hours. Your guard is completely down. The office is designed that way. Small room, one desk between you and the manager. Comfortable chairs, soft lighting, a box of tissues on the corner of the desk, because apparently some people cry in there and the dealership is prepared for that. Nothing about it says negotiation. Everything about it is. This is not an accident. The F&I office is, for many dealerships, the single most profitable department in the building. Not the showroom, not the service bay. The back office where you sit down after you've already said yes. Some dealerships make more gross profit per transaction in the F&I office than they make on the entire vehicle sale. Think about what that means. The car, the thing you came in for, the thing you researched for 3 weeks, the thing that takes up the entire lot, is sometimes the less profitable part of the transaction. The profitable part is the paperwork you sign after. The product mix in that F&I office? 5, 6, sometimes 7 separate revenue streams. Each one structured to feel optional. Each one presented after your decision is already locked. Not financial advice. Just a guy who actually read a dealership's F&I compensation breakdown and got genuinely angry about it. Legally, I have to say that first. Personally, I think this is just math they really hoped you'd skip. Here's how the system works. Because once you see the mechanism, you can't unsee it. When you finance a car at a dealership, 2 completely separate transactions happen. 2 profit centers. 2 deals. Deal 1. The car. Price, trim, negotiation, floor mats, all of it. You know that deal. You think when you shake hands on a number, the business part is finished. It isn't. Deal 2. The loan. That's where the real extraction happens. The dealership doesn't lend you money directly. They're a middleman between you and a bank. Chase, Ally, Capital One, a credit union, whoever. The bank evaluates your credit score, your income, your existing debt, and gives the dealer a number. That number is called the buy rate. It's the lowest interest rate the bank will approve you for based on your actual financial profile. Your real rate. The one you actually qualify for. Let's say your buy rate is 5%. The dealer does not have to offer you 5%. They can mark it up, offer you 6%, 7, 7.5, 8, whatever you'll accept without getting up and walking out. And the difference between your buy rate and the rate you sign? The dealer splits that with the bank. That spread, that markup, is their second income stream off your purchase. It has a formal name in the industry, dealer reserve. In street terms, a hidden commission on your interest rate. You qualified for 5%. They offered you 7.5. That extra 2.5% isn't going to your loan principal. It's going to the dealership. Monthly, for every month of your loan term. Now, here's where it gets particularly precise, because it's not random. The finance manager doesn't pull numbers out of thin air. They're trained to read you, your urgency, Whether you came in alone or with someone, how many times you've asked about monthly payment versus total price. The more focused you are on, can I afford the monthly, the more room they have to work with on rate. And they've been doing this conversation hundreds of times. You're doing it once. Different buyers, same car, same dealership, same day. Different rates. The spread isn't fixed. It's calibrated to what each buyer in each chair is likely to accept. A buyer who walks in pre-approved and mentions it early? Lower markup, or none at all. A buyer who walks in focused on, what can I do a month? That buyer leaves with a rate that was designed around their ceiling, not their floor. Here's the part that should genuinely bother you. You will never see the buy rate on your contract, because legally, dealers are not required to disclose it. The only number that appears is your final rate, not the buy rate, not the markup, not what the dealership is taking off the top. You are negotiating blind. In a room where the other party knows both numbers, that's not a fair negotiation. That's an information asymmetry. Wall Street terminology for, they know something you don't, and the gap is where the money lives. The CFPB, the Consumer Financial Protection Bureau, the federal agency that tracks exactly this, has documented that dealer interest rate markups add an average of $1,000 to $2,000 to a typical auto loan. On longer terms, 72 and 84-month loans, which now represent the majority of new car financing because they lower monthly payments and make expensive cars feel affordable, that number climbs significantly higher. The longer the term, the more total interest flows through the spread. The bigger the loan, the more each percentage point costs you. Meet Marcus, 23 years old, first real job, $60,000 a year, which felt like he'd made it, until rent reminded him where he actually stood. He needed a car. Nothing flashy, just reliable transportation to get from his apartment to the office without depending on the bus schedule. He did his homework on the car. 3 weeks of research. Reliability ratings, depreciation curves over 5 years, trim comparison videos on 4 different channels. He walked into that dealership prepared. He had a target price, a target trim, and a firm handshake energy. The salesman was genuinely good, patient, no pressure. Let Marcus test drive twice, pointed out practical differences between trims without pushing unnecessary upgrades. Didn't once mention the premium package Marcus hadn't asked about. Marcus liked him. That's important context for what comes next. They agreed on a price. $32,000, down from $33,700. Marcus felt good. He'd negotiated. He'd used everything he'd read about dealership tactics. He was ready to sign. Great, the salesman said. Let me just walk you to finance to get the paperwork sorted. And that's where the second deal began. The finance manager was younger than Marcus expected, friendly, unhurried. He offered water. He walked Marcus through a menu of add-on products: gap insurance, extended warranty, tire and wheel coverage, paint protection, a prepaid maintenance plan. Marcus said no to most of them, 4 out of 5. He felt sharp. He felt like he was winning. Then the loan sheet appeared. 7.5% APR, 72-month term. Monthly payment, $512. Marcus ran the number in his head. $500 a month. He could handle that. He signed. What Marcus didn't know, his credit score, 708, qualified him for a buy rate of 5%. The dealership marked it up 2.5 points. On $32,000 over 72 months, that difference costs Marcus $3,800 in additional interest. Not additional to the car's value. Additional to what he would have paid at his actual qualifying rate, $3,800, going to the dealership. Because nobody in that room was legally required to mention there was a lower rate available. Marcus thought he bought a car. He also funded a bonus for the finance department, and the extended warranty he said no to? The finance manager still made his base on the rate. The no to add-ons didn't cost the dealership much. The rate was the real prize. Now the data. Because Marcus isn't a fluke. He's the standard. 79% of new car buyers finance through the dealership. 79%. Nearly 8 out of 10 buyers sit in that F&I office and let the dealership arrange their loan. The same dealership that profits from arranging a higher rate loan. The same dealership that's the only party in the room who knows both the buy rate and the rate they're offering. Here's another number. According to Experian's State of the Automotive Finance Market Report, the average monthly car payment for a new vehicle crossed $550. On a term approaching 70 months average. Do that math. $550 times 70 months is $38,500 out of your pocket, for a loan that may have started at $35,000. That gap is the cost of borrowing, and a portion of it on most of those loans is dealer reserve that nobody explicitly mentioned at any point in that conversation. The average new car loan in the United States has crossed $40,000. At 5% on $40,000 over 60 months, total interest paid is around $5,300. At 7%, same loan, total interest paid is $8,150, nearly $3,000. Gone. Not to your car, not reducing your principal, to interest, a portion of which flows back to the dealership. At 7.5%, total interest climbs to $8,800. That's $3,500 more than you would have paid at the buy rate. Multiply that across the roughly 17 million car sales per year in this country, and the majority of those being financed through the dealership, and you start to understand the scale of the extraction model. This isn't edge case behavior. This is the designed default outcome for buyers who don't know the game. Let's talk about the add-ons. Because the rate isn't the only line in that F&I menu, gap insurance, extended warranty, tire and wheel protection, paint and fabric protection, key replacement, prepaid maintenance. Some of these are real products. Some carry genuine value depending on your situation. But the price markup in the F&I office versus what you'd pay buying the same product elsewhere is, in most cases, substantial. Gap insurance, which covers the difference between what you owe on the loan and what your car is worth if it gets totaled before you've paid it down significantly, is a real thing worth having in the early years of a loan, especially on a longer-term financing arrangement where you're building equity slowly. The dealership will charge you $400 to $600 for it, folded into your loan, which means you're also paying interest on that $400 to $600. Your existing auto insurer can often add gap coverage for $20 to $30 per year. Same protection, different price tag. Extended warranties are similar. The F&I office will present you with the dealer's preferred product, priced to generate margin. Third-party warranty companies offer comparable or often superior coverage. The difference is they're not selling to someone who's been sitting in a showroom for 2 hours and whose decision-making energy is depleted. Here's the move with every add-on. Ask for the paperwork. Take it with you. Nothing expires overnight. The car exists tomorrow. If the product has real value, you can buy it separately for less. If it doesn't, you saved yourself the upsell.
The finance manager's job includes a menu presentation. That's a known structure. It's not personal. But every item you say yes to in that room, you're paying a retail markup on top of a product that exists in the open market. That's the structure. Okay, 0% financing. The banner. The commercial. 0% APR for 60 months on select vehicles. Sounds like the solution, right? No interest. Free money. Problem solved.
Here's what 0% actually means. First, select models. That phrase is doing enormous work. It means inventory they need to move. overproduced trims, last year's configurations, the version nobody picked in the colors nobody wanted. Usually not the car you actually want. Second, credit requirements. 0% financing typically requires a score of 740 or higher, which eliminates the majority of buyers from qualifying before they've even sat down. Third, the offer usually comes from the manufacturer's own financing arm. Ford Motor Credit, Toyota Financial Services, GM Financial. These are not neutral parties. Their job is to move manufacturer inventory and generate return on their lending portfolio simultaneously. The 0% promotion is a calculated marketing expense. Manufacturers subsidize the interest to accelerate sales volume on specific units. You're not getting free money. You're getting money where someone else paid the interest cost on your behalf in exchange for something specific. Which brings us to the fourth condition. When you take 0% financing, you almost never negotiate the purchase price. You're paying full MSRP, manufacturer's suggested retail price. Let me be clear. MSRP is not what people actually pay for cars. It's the ceiling. The window sticker, the number that exists to give the dealer room to come down. The 0% offer takes that room away entirely. Put real numbers to it. A car at $30,000 MSRP. You could negotiate it to $27,000 and finance at 4.5%. Over 60 months, total out-of-pocket including interest comes to approximately $28,030. Or you take the 0% promotion. Full MSRP, no interest, 60 months. Total out-of-pocket, $30,000. The free financing option costs you almost $2,000 more than the negotiated price with market rate financing. They took the discount you would have negotiated, wrapped it differently, labeled it a benefit, and sold it to you as a deal. 0% isn't a financing innovation. It's a marketing reframe of the same extraction, just with a better banner outside and a TV commercial with upbeat background music. Here's where the psychology gets precise, because it's not enough to understand the trap. You need to understand why it's so hard to see in the moment. You've been at the dealership for 2 hours when they walk you to the F&I office. The big emotional decision, I'm buying this car, is already made. Your brain has committed. You're not evaluating anymore. You're executing. The finance manager knows this. They're not unkind, they're trained. They present the loan terms after you're already mentally in that car, already thinking about the drive home, already past the decision point. Cognitive science has a name for this. Post-decision rationalization. Once you've decided, your brain starts building reasons the decision was right. It resists new information that complicates it. Questioning the loan rate means potentially questioning the entire decision, and your brain doesn't want to do that after 2 hours of investment. There's also the fatigue factor. 2 hours of active negotiation depletes exactly the kind of mental energy you need to scrutinize a loan sheet with fresh eyes. The attention you started with, sharp, prepared, ready to push back, is not the attention you have when the loan paperwork slides across that desk. The F&I office is specifically walked into after the energy is already spent. And then there's the anchor. The salesperson spent 2 hours focused on one thing, the monthly payment you could manage. Not total price, not interest rate. The monthly. Because $512 a month sounds like a number you can live with. Nobody puts it in front of you and says, that's $36,864 over 72 months for a $32,000 car. The monthly payment is the anchor. The total cost is the number they prefer you calculate after you've already driven it home. The F&I office is designed to be walked into after the decision point. That timing isn't accidental, it's operational, and it's been refined over decades of practice. Here's how you actually play this differently. 30 minutes. That's all the preparation takes. Before you step foot in a dealership, go to your bank or, better, a credit union. Credit unions are member-owned, non-profit financial institutions. They exist to serve their members, not to maximize yield on a lending portfolio. Their rates tend to be meaningfully lower than dealership financing, and they have no dealer reserve arrangement with anyone. They're not in the business of marking up your rate and splitting the spread with a third party. Apply for a pre-approved auto loan. They'll review your credit, confirm your income, and give you a letter, approved up to a specific amount at a specific interest rate. You don't have to use it. There's usually no cost to get it, but it transforms your position completely. You walk into the dealership as a buyer who has financing and is simply open to something better if the dealership can offer it. Not a buyer who needs help. Not a buyer who is dependent on whatever rate they present. When the finance manager slides a loan sheet across the desk, you have a benchmark. You can say, "I have pre-approval from my credit union at 5.1%. Can you beat that?" Watch the dynamic change. One of two things happens. They beat your rate, meaning you got genuinely better terms than you came in with, or they can't, and you use the credit union. Either outcome, you win. Because now the conversation is about rate, not about whatever number was going to appear on that sheet. The pre-approval is leverage. The only tool that forces the dealership to compete on interest rate rather than obscure it behind monthly payment math. Second part of the move. Negotiate the car price first. Completely separately, before any conversation about financing enters the room. Dealerships prefer to bundle everything. Purchase price, trade-in, monthly payment, interest rate, add-ons, into one long, blurry conversation. When you're focused on the monthly, you stop tracking the individual numbers. $540 a month sounds manageable. Over 84 months, that's a total that looks very different. Don't let them bundle. Get a purchase price agreed and in writing before financing enters the conversation. Not a monthly payment, a total price, out the door. Then, and only then, move to the loan. If the salesperson tries to steer back to monthly payments before you've locked a purchase price, you say, "I'll work out the financing separately. What's the best out-the-door price on this vehicle?" Keep asking until you get a number, not a payment. That's the only number that matters at this stage. On the add-ons, you are allowed to say, "Let me think about that," to every single one. You are allowed to take the paperwork home. Nothing expires tonight. The car exists tomorrow. Gap insurance. Price it with your existing insurer first. Extended warranty. Look up third-party providers before you decide. Paint protection. It's almost always cheaper as an aftermarket product. You have time. Take it. Back to Marcus. Same situation, same credit score, same car, same dealership, different preparation. 30 minutes on his credit union's website before he went in. Pre-approved at 5.1% on up to $35,000. Letter in his phone. He negotiated the car price first, separately. Got it to $30,000 flat. Walked to the F&I office. The manager opened at 7.5%. Marcus put the pre-approval on the desk. "I have 5.1 from my credit union. Can you do better?" The manager stepped out. Came back at 5.75. Marcus said nothing. Looked at the letter. The manager came back again. 5.2. Marcus. 5.1 is what I have in writing. Match it, and we're done today. They matched it. Same car, same dealership, same purchase price. 5.1 instead of 7.5. Total savings over the life of the loan? $3,400. $3,400. Because Marcus knew there was a second deal in that room before he walked in. 30 minutes of preparation. One credit union pre-approval letter. That's the entire difference between Marcus's outcome and what the default outcome would have been. Here's what I want you to understand about all of this. None of this is illegal. Nobody is going to prison. The finance manager isn't a villain. He's doing his job, and his job is to maximize the yield from every transaction that sits down across from him. That's the incentive structure. That's what his compensation plan rewards. The salesperson who was genuinely patient with you, who let you test drive twice, who didn't push add-ons you didn't need, he was also doing his job. The system doesn't require anyone to be dishonest. It just requires you to not know the rules. And for a very long time, the industry was very good at maintaining that condition. The gap is the whole game. They know your buy rate. You don't. They know the ceiling they can push you to based on your body language. You don't. They know you've been there for 2 hours and your decision-making energy is depleted. You know it too. But you haven't thought about what that does to your ability to scrutinize numbers. They know which add-ons carry the highest margin and present them first. You don't. And for the majority of buyers, that gap between what the dealer knows and what the buyer knows is the entire profit model on the financing side. It still is. Not because you're incapable of understanding the numbers, because nobody made sure you did before you needed them. Not in high school, not in most personal finance courses, not in the paperwork that slides in front of you. That paperwork is designed to look thorough while revealing only the minimum legally required. The people who know the game are the people inside it, or the people who got burned, went looking for answers, and found them after the fact. You're looking now, before the fact. One more thing, because some of you are reading this after you've already signed. You can refinance. Banks and credit unions refinance auto loans. Same concept as mortgage refinancing. You replace your existing loan with a new one at a better rate. If your credit has improved since you bought the car, or if you bought when rates were high and they've moved since, or if you simply didn't shop your rate before signing, refinancing is a real option. It's not complicated. It typically costs very little or nothing in fees. And the math is usually straightforward. Take your current rate, compare it to what you qualify for now, calculate the difference over your remaining term. If the number is significant, you make the call. If it isn't, you move on. But check, because sitting on a rate that was marked up 2% for 4 remaining years of a $40,000 loan is a fixed cost that has a fixable answer. The move exists in both directions. The pre-approval, separate price negotiation, add-on awareness, refinancing if needed. That's the move. Not a secret, not a hack, just information they assumed you wouldn't bring into the room because, historically, most people didn't. 1 hour of preparation, potentially thousands of dollars saved over a multi-year loan. Run the actual math for your situation. Your credit score, your loan amount, your term. The pattern holds. The gap closes the moment you know it exists. Not financial advice. Just 2 monitors, a dead Red Bull, and a dealership F&I compensation document that was absolutely not meant for general circulation. Your situation is yours. Talk to someone who knows your full picture before you restructure anything. What I'm showing you is the pattern. What you do with it is your call. Don't let them play you. Listen to what they're actually saying.